6% this year, and we're only 2 months in. We've got the rhythm of the market at the moment. That's what people are trying to do. We just got to make sure we stay in that rhythm. We don't lose the beat.
We're still the 6th biggest stock market in the world, but at one time we were the 2nd or 3rd biggest stock market in the world. Korea is now the 9th biggest stock market in the world. It's overtaken the German DAX and France's CAC 40, which is their main indices.
Monday, the software companies got destroyed again. As people read this article and said, God, if there's an element of truth in this, this is a real problem.
Not to bring back too much trauma from the weekend, but in Scotland, what we say is they've got to lift their kilt and show us what they've got.
That is a frightening thought. If you saw Rich this weekend, that would be something that would put you off your Nando's.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 34 of The Art of Investing, brought to you by IG, the global investment platform. I am joined today by Chris, sore loser Fellingham.
Hey, that's me.
And my good friend, Mark Spice Holden.
Hi, Rich.
Gents, what have we been up to this week? We saw each other a little bit more than usual, didn't we?
We did see each other quite a lot. It's been a bad week away from the markets. Firstly, we went to Wales, watched the boyos to turn up for a change, play a great game, and then lose in the last few minutes, which was slightly upsetting. Then, as predicted on the Sunday, Spurs went down in a heavy defeat to Arsenal. So, pretty poor weekend, but then things got a lot worse when we learnt on Monday that our good friend, colleague, confidant, and all-round great guy, Stewie Nyman, had succumbed after his heart attack 3 weeks ago. Very, very sad, and a reminder that tragedy can happen at any time. So time to live your best life, I think, is the right advice here. Our sympathies obviously go out to his wife and family at this awful time for them.
Yeah. He was such a wonderful man. Yeah, apart from the sad news about Stu, my week was actually dominated by being unable to pick a winning market or winning side because I chose to support Wales against Scotland at the weekend and succumbed to the better Scottish team. And then I had to eat even more humble pie because England got thrashed by Ireland at home.
Wasn't a great afternoon for you, was it?
No, it wasn't. It's not been a great week.
Well, I had to go to the depths of desperation to eat on the way home. So I could either get the 8 p.m. train, which took 2 hours, or I could get the 9 p.m. train, which took 3 hours. So I decided, right, I'm going to run for the train, get on the platform, but then realised there was no buffet car on the way back to London.
Buffet.
My God, you're showing your age now, boy.
we at some point we forgot to eat was the problem. So we went from lunch at 1 p.m. through to 8 o'clock without having eaten. So I decided, right, we just left Bristol Parkway. And I thought, I'm going to try something here. I'm going to try and get a Deliveroo driver to meet me on the platform as the train pulls into Didcot Parkway.
You're joking. That's fantastic. That's really the gig economy, isn't it? Anytime, any place, anywhere, Deliveroo will get it to you.
And big shout out to Lewis, who actually stood on the platform for 5 minutes waiting for the train to come in, got himself to the right carriage, and then did a very smooth turnover of a Nando's.
So you ordered it in Bristol, picked it up at Didcot Parkway, and it all worked smoothly.
Yeah. Perfect.
Who says this country's broken?
Right, shall we move on to the important thing of the week? Spice, what's been going on?
Well, we thought we had a bad week, but so did Trump. He got trumped by the Supreme Court, who made his tariffs illegal, basically. And we'll talk about that a little bit more later. But that was probably the big headline of the week. But elsewhere, away from the US, actually it's been a very good week for equity markets. Particularly, we've had all-time highs in the FTSE again.
Yes.
The Stoxx 600 and the Stoxx 50, the European main indices, also hit new all-time highs. And Taiwan and Korea also took out highs, which helped lift the emerging markets to another new all-time high.
Which we've got thanks to JP, was it? Or
yeah,
I think there's a little bit of a dig there. Sorry, JP, I didn't ask him to say that.
Now we've got 10% in emerging markets, and actually we've got 10% in the FTSE. We've got 5% in the Euro Stoxx 600. Another market that did well again was Japan. It took out another all-time high. This because the Prime Minister there, Sanae Takaichi, basically appointed 2 new members to the Bank of Japan's board who were seen as dovish. And if you remember, dovish means that they're more likely to want to cut interest rates than put them up. And so that helped take Nikkei up to the magic 60,000 number, which you remember I like big round numbers as being an equity guy. But also gold and silver had a great week, and that helped lift our BlackRock World Mining Trust to a new all-time high. And we've got 5% of that as well. So we've had a pretty good week, as you'll see when we come on to talk about the performance. But just on that note, Korea is now the 9th biggest stock market in the world. It's overtaken the German DAX and France's CAC 40, which is their main indices. So that's pretty impressive. Go on, Korea. Elsewhere in equity news, we come to the very end of the reporting season. The ones that, there's been loads of little results, but the ones that really jumped out to me was HSBC, the UK's second biggest company. We're up 6% on the back of their results. Very good all-round numbers. And that helped, one of the reasons the FTSE 100 went up to a new all-time high. It's about 8% of the FTSE 100, so it's a big constituent. And then the one that we really were worried about and everyone was focused on was last night, which is Wednesday this week. Nvidia, the world's biggest company, had their results, and actually they were very good.
The guidance was huge.
It was. They continue to deliver on both earnings, but also revenues, that's the higher quality, and that's what equity investors look. They're more impressed with the revenue beat than they are for an earnings beat, but they beat on both counts, and the upgraded forecast going forward. So there's no sign of a let-up in demand for their AI chips. And the shares, were flat after that, but they'd risen about 4% this week. So, that was pretty good.
Does that worry the tech brigade, that the darling of the market, which has been such a great performer, brings out great results, great forecasts, but can't get the stock price higher?
A bit nervousness. Last time it happened, then the stock dropped quite significantly in similar circumstance. But that guidance is just so huge out there. Although he didn't do a great job of explaining where it comes from. That was some of the nervousness.
Yeah, exactly. But look, we've got to put it in perspective. The world's biggest company, it's up nearly 6% year to date, up 4% in the last week. It has delivered. There are big chunks of the tech sector that are under pressure, we've talked about before, because of the introduction of AI. And it's particularly hurting the software companies, if you remember. And that makes up about half of the technology sectors all around. And those companies continue to be hurt very badly. In stock market terms, they've had a crash, which means they've fallen more than 20% so far this year. It's been brutal. It's written off $3 trillion worth of market capitalization, the values of these companies worldwide. Now, we're just starting to see a little bit of a floor maybe being put under those. People have just shot first, asked questions later, and there's plenty of babies, I think, being thrown out with the bathwater, unfortunately. So for stock pickers out there, those of you who do that sort of thing, maybe you'll find some bargains.
We got a question coming up about that later on. It's quite an interesting one, so worth sticking around for.
Yeah. The other thing I wanted to talk about was, we've talked about Novo Nordisk, which at one time, last year, was Europe's biggest company. It's been overtaken by ASML, who make the machines that make the chips that go into AI. Novo Nordisk this week faced what's called a generic competitor. Came in, they've got their drug, weight loss drug, as we know. They're famous for that. And there's a constituent of that called Wegovy. It's under patent still. And when you're a drug company and you develop a drug, you put a patent on it, and that gives you 20 years of protection from when you register it to when actually someone else can come in and compete with you. This week, someone decided to go and compete with Wegovy, and Novo Nordisk's main constituent for that weight loss. And basically, they said they were going to put a pill out. And the shares fell 20% this week. And, we've talked about it a lot, Novo Nordisk, in the last few weeks, and it's just been under pressure. It's had profit warning after profit warning, prices coming down. So, down another 20% this week. I don't think they're on the edge of falling out the top 10 stocks in Europe. having
Wow,
been
that's a
the biggest stock.
That's a big thing, but it follows the advice you've given before, Mark, which is, within the equity market, as you know, I'm not a follower of the equity market as close as you are, but what you tend to find is that, profit warnings, disasters, things like that never run on their own. There's never one cockroach, I think was the expression that you've used before. And they've been warning about this, they've been warning about that, they've had bad trials, and it just carries on and carries on. So good lesson there. When things start getting unexpected, when things happen that you're not expecting to happen to a stock, get out quickly is normally good advice.
Yeah. They don't sell profit warnings in packs of one. They normally come in packs of 3.
Takes us on to Diageo. Yet again, Dave Lewis coming in, and the stock had actually bounced off its lows. The amount of Guinness that we drank at the weekend could have helped that guidance, but it was cutting guidance again, and the stock down 10% yesterday.
But he cut the dividend as well, didn't he?
Mm.
Yeah.
Massacred that.
What happens when a company cuts a dividend? There's a bit of a different reaction usually, isn't there?
Yeah, I mean, companies should be brave enough to cut dividends if it means that they need to retain the cash for something else or reinvest back in the business. But in the UK particularly, investors love dividends. It's quite different to America. American companies tend to return cash to shareholders through share buybacks and a bit of dividend, but mainly share buybacks. In the UK, it's mainly a dividend culture. And companies are under pressure to maintain these dividends, even though sometimes their cash flows don't allow it. But if you cut those dividends, there's a whole big investing community in the UK that then steps back from it. They have to sell those shares because if the dividend yield, as it's called, so the interest effectively you're getting on per share from your dividend, if it goes below the market average, then a lot of income investors have to cut out those positions. Now, they can ride it for a bit and hope that goes back up. But if you've cut the dividend aggressively, as Diageo did, then you have to basically expect to lose a large chunk of shareholders. And that first wave of selling would have been mainly income funds probably getting out.
It certainly looked like it. It was, a downward trajectory from the market open to the market close.
Yeah. I say the UK is very focused on dividends, unlike the rest of the world, but particularly the Americans, they don't really focus too much on the dividends. They'd rather they took that cash and invested it back in the business to grow.
Yeah, I suppose you could look at it slightly differently. You could say that what was supporting the share price was that yield, because there are so many yield investors in the UK, that they were actually holding it at the higher price than it should be trading. And therefore, by cutting the dividend yield, it went to where it should have been the whole time.
Exactly.
And that's unfortunately what tends to happen. People always say, "Oh, well, it was discounted. The dividend was going to be cut," and it never is. The market always takes those things badly on the first day. After the first day, who knows? But the first day is normally quite ugly.
One of the first lessons I learned as a fund manager, I used to run some income funds back in the day, back in the early 90s, was that things have a high yield or a high interest rate for a reason. And if you see a high interest rate, that tells you that the underlying business isn't doing particularly well, or it's coming under stress to generate cash to be able to pay that. Now, sometimes they pay it and you might make 6 or 7% by them paying the dividend. But if it gets to about 6 or 7% or 8 or 9, the market is telling you the likelihood is that's going to be cut or passed, which would be even worse. And the shares will then correct, as Chris says, back to a price they probably should have been at in the first place. Yeah. So don't always go greedy. Don't get greedy when you go looking for high interest rates or high dividend yields. And you remember when the Icelandic banks went bust back in the credit crunch.
Your Kaup thing.
Yeah, Kaup thing. And those banks were offering huge interest on deposits, on cash deposits, which a lot of people in the UK put money into. They ended up going bust and they didn't get any money.
Including local councils.
Yeah, there are lots of people who fell for that. So that lesson there is just because it's got a high interest rate doesn't mean it's good. In fact, it probably means the opposite.
I would put a slight wealth warning on that, in the sense that there are parts of the stock market where they do yield a lot more, but they tend to pay all the time. And I'm talking about insurance companies now, people like that. There's high yield there, Aviva, people like that. You can get good yields on, and that would seem to be quite safe. But I think where you're correct is that what people don't really understand, and the reason why the yield is that high, is that they are very linked to what's going on in the stock market, and they're very linked to corporate bond prices and things like that. So if there is a crisis, they would also get caught, and so there's a risk premium built in there just in case something was to go wrong. So I would agree with you completely with an industrial company. When the yield goes up, it's telling you there's a problem. I think you just got to be slightly more careful in some areas of the market that there's structurally high yields, but they are there for a reason. You're correct.
That's very true. That's very true.
Sounds like there's an art to that as well. Picking the attractive dividend yields if they're there for the right reason. HSBC was 6.5% about 12 months ago, and the stock's up 60, 70% since.
Yeah, it's been a great performance.
And that's, as Mark says, that's where the skill of an equity fund manager comes from. My experience is not in that area of the market, but there are a whole host of people in the UK stock market who are equity income fund managers, and that's their job, to see which of these dividends are sustainable and which of them aren't, and therefore rejigging their portfolios to be in the right place.
Before we continue, I just want to let you know about a limited time offer from IG. Right now, if you transfer your ISA to IG before the 5th of April, you can get up to £3,000 in cash. That's right, you'll earn 1% cash back on transfers up to £300,000. This is a great opportunity if you've been thinking about consolidating your investments and making the most of this great bonus. To take advantage, just use the promo code ISA Podcast. That's ISA Podcast, all in block capitals when you transfer in. This offer is available until April the 5th and is for new share dealing customers only. For full terms and conditions and to get started, head to IG.com.
Now, talking about other things that could disappoint, we've had more bad news out of private credit and the private markets. There's a company called Blue Owl who have shocked their investors this week by basically stopping them taking any money out of their funds. Now, it's called gated or being sidecarred, and basically they've stopping their investors in those funds taking money out when they want to. Now, because it's private, they only let their investors take money out once every 3 months. But now they've stopped them altogether. And they're now going to sell all the assets within that private fund and then try and return what's left back to the shareholders. But, there were lots of people who jumped on that and said, oh, here we go. It's going to be terrible for private credit, including Jamie Dimon, who, if you remember a month or two back, warned about where you see one cockroach, you see more than one cockroach, you're bound to see others. He's got a bit of a campaign against these private companies and the private credit market. And he warned about it again this week. So, yeah, I know it's one of your bugbears, Chris, but
I'm in good company if Jamie Dimon's saying the same thing.
Yeah.
But the important thing about them is, if people have been following what's been going on in the press over time, the private equity industry now, how can I describe this in a way I won't get sued for it? The private equity industry has found so many buyers on the institutional side, there aren't any institutions left to buy private equity. So what did they decide to do? They started campaigning to allow retail investors to buy it. Now, we've got a history in the UK of understanding that you should not have illiquid investments within vehicles that private investors can access, because they might just all want to sell the next day, and these things are illiquid. Woodford was a perfect example of that, but we've also seen with property in the UK, people have had property unit trusts where retail can buy and sell daily, and suddenly a big amount of money is coming out, and they have to gate themselves and stop that payback. Now, in America, they've suddenly made it, and it's also here as well, we've suddenly made the opportunity for people to be able to buy into private equity and imagine it's as liquid when it completely isn't. And we'll be talking a little bit more in this update about some of the things that can affect the private equity and private debt world, and indeed are. There was this article out, I don't know whether you guys saw it, by Citroni Research over the weekend. Now, I think it was sort of one man and his dog, or just about that sort of size organization. But they brought out a article which basically said AI is moving at a rapid pace. So let's put a scenario out there, a dystopian AI scenario, that sort of thing. Too scary for me, but basically that AI would move much more quickly in its adoption than anybody's talking about now. And so they wrote an imaginary market report for 2 years' time basically talking about the stock market had collapsed, there was mass unemployment everywhere, bond yields were lower, and all this sort of thing. Now, people write this sort of stuff and you think, oh, that's great. Monday, the software companies got destroyed again. As people read this article and said, God, if there's an element of truth in this, this is a real problem. But this is my area of expertise. I just think it's quite funny that somebody wrote this and it affected the market. Tells you there's a grain of truth or kernel of truth in there somewhere. But you guys are much bigger experts than me. What did you think of this article?
That's the first time he's ever said that, isn't it?
Got to be nice to people sometimes.
Get the editor to loop that in a few times in the future.
Well, I happened to see the guy who's quite a young lad being interviewed on Bloomberg, and I think he was very shocked himself at quite what a market impact he'd had. Because, as Chris said, on Monday there was 5 or 6% falls in many companies across the software area and other areas. So they were hitting credit card companies, they were hitting traditional banks. They anything to do with consumer research, getting absolutely hurt. HR companies, process-driven businesses. These are areas that everyone thinks the AI is going to come through. And as Chris says, he's talking about the impact of this going much quicker than people are expecting. And he was pointing to the fact that over the next 18 months, you could lose 5% of white-collar jobs. That's a big number.
Yeah.
That's a big number. Now, what I would say as a counter to that is if you saw that, and we've talked a lot about the worry about the impact on unemployment of AI. If it was to accelerate that fast, you would get central banks starting to react to it. I'm convinced that the Federal Reserve would probably be the first to react to it. And they would say, we need to cut interest rates to create jobs. And that's what would happen. And the stock markets would love that. But, the first impact of losing lots of jobs, as long as your business stays broadly the same, your profits will go up a lot. And that's one of the things that stock markets will go up.
Yeah. I took from the research report 3 areas that it was clearly exaggerating for effect. And the first one was just the time of implementation. We know from speaking to companies, there's no way that AI will be managed to be implemented and have that effect in 2 years. So, then you'd say, well, it's coming in 4 years then. Well, no, because the slower amount of time the implementation takes and the job losses come, the more time there are for people to retrain and the government to respond. That was the second point, that it gives absolutely no chance of any government intervention or central banks or the positive effects that it can take. It was almost as just, right, if nothing was done from today, then yes, in 2028 we would have problems. But we know the world doesn't work like that. And then finally, it assumes that labor disruption automatically results in financial meltdown. And we know from speaking to Francis that it doesn't quite work like that. The jobs that are being taken, yes, it will have an effect, but not necessarily on the stock market. Does that come back to private debt?
As I said, I'm not an expert at how the equity market would react to these things. I tend to think like Mark that interest rates would be cut more aggressively than expected, and that would create loose monetary conditions. And so as an investor, not really sure why that's negative until, or if you got to that point where you couldn't cut rates anymore and it was still happening, in which case there might well be a problem. But, we're miles away from that sort of thing. The bit of research that I really liked within there was talking about the effect on some of the asset classes. So, for example, they talked about S&P, the S&P 500, down to 5,000, but having hit 8,500 first. So, this is not something to worry about immediately, but maybe something to worry about going forward. Bond yields they had down about 70, 80 basis points. Remember, bonds yields down, prices are up. Thank you. And I think if there was this really going on, the bond yields would be much lower. And so that would be helpful for the market. But the area that I really wanted to just briefly touch base on was this private equity and private debt area. In the private equity industry has been putting its money into companies that are obviously not listed on the stock market. A lot of these are software companies. A lot of them are people who are providing services, software as a service, SaaS, to most companies. And the problem is, where are those marks? Now, the marks on that private equity, when I say marks, what do I mean? I'm not talking about Mark Holden or even the Mark's lunch. What I'm talking about is, where are they priced? Where did people say they're actually worth relative to where they were bought, those marks are in the books at a high level. Now, already you're seeing people starting to pull those down. This is what happened to Blue Owl. Blue Owl has pulled down those marks quite considerably, which is what's caused the problem, which is why everybody's rushed for the exit. So what we were talking about just now with regard to the retail response to this sort of thing.
An example like in subprime, everything was marked at 97% chance of it being fine, the debt or the bond. So you get 97 pence back in the pound.
In 2008, just quick history lesson here, all the subprime mortgages were all brought together, remember, and made into different tranches. So you could have a AAA tranche, a AA tranche, a single A tranche. It was all rubbish. The AAA tranches were always priced 99. Well, their real marks were something like 20. And people had to take that loss. And when you take that loss, it causes all sorts of problems. And that is the issue to me in the private equity industry at the moment. The private equity industry is running these marks at very high levels. They're going to have to pull them down. And all this supposedly great performance you were meant to get by putting all your money in private equity and locking it away for 7 or 8 years isn't going to happen. So this is, to me, one of the biggest things that we need to be thinking about. And actually, what helps our portfolio, we'll talk about that next, but with our portfolio, we're all in publicly listed equities. And of course, most of the institutions have been underweighting publicly listed equities to buy private equity.
Yeah.
Now they're all stuck in private equity, and all these public listed equities are going up. And they're saying, get me out of that private equity and into this public stuff. They can't get out.
Yeah.
And that's the big problem at the moment.
And it's definitely happening in private credit as well. And UBS, interestingly, the Swiss are very smart people, right? When it comes to investing, we know that. But UBS, the biggest bank in Switzerland, basically this week said that they expect an increase of 15% in defaults on private credit. So private debt, those people are going to stop paying their interest on that private credit. And so the companies are going to start going bust if they're exposed to this AI area.
And the marks will go down in those companies that have invested in them. So this is something that is in the background, something we need to keep an eye on, not affecting our portfolios. But if it is a big problem, may start to. So we've just got to keep an eye on it and watch it. But so far, that's where we are.
I think at the moment we're probably benefiting a little bit because people are trying to get money out of that area and hopefully rotate it back into some of the traditional markets, as Chris says, like, the FTSE 100 or the European indices.
Not to bring back too much trauma from the weekend, but in Scotland, what we say is they've got to lift their kilt and show us what they've got.
That is a frightening thought. If you saw Rich this weekend, that would be something that would put you off your Nando's.
You especially enjoyed when I shouted out, I waited for a very quiet moment in the game when we were getting stuffed just before halftime. And I shouted out, come on, Scotland, just pretend that they're English.
That got a very, very large response, a positive response from everybody there.
So on that note, we will turn to things a lot more easy on the eye, and that is the portfolio performance for the week. Mark, it's been a beauty.
It has been a very nice week for us. And we've been handsomely rewarded by being skewed away from the US this week. I mean, US haven't done badly. Their markets are up a little bit. But actually, the big winners this week were the commodities. And part of that is because this week we had a judgment on Trump's tariffs. And those tariffs were basically deemed illegal. So a lot of these countries that have done bad deals with Trump breathed a big sigh of relief. But he then immediately put out what's called a 122 notice and imposed 10% tariffs across the world for everyone who is involved in it. But that initial ruling meant people went and started buying commodities again. And gold and silver have had a very good week. And silver's up double digit again. And the BlackRock World Mining, which, as you know, is one of our biggest positions, it was a major beneficiary of that. And it's up 6.7%, our best performer this week.
Fantastic week.
Yeah. Even crypto had a better week.
Go on, my son.
Touching wood as I can. So our VanEck Crypto and Blockchain Innovators Fund ETF was up 4%.
And that's important because we've got 7.5% of that. So as Rich pointed out last week, that's quite a sizable position in a very volatile thing. So phew, sigh of relief. for the moment, but keep a close eye. Sorry, Rich, you were saying.
Well, also just as well, because we now have a video on TikTok asking you guys if you think that crypto's bottomed. So if anybody wants to see the behind the scenes of this podcast, then you can go onto TikTok and it's _the art of investing. And you'll find these two videos commenting after the podcast is finished, and maybe a little bit of a quiz or two as well, as more background on how they got to this point in their careers.
Well, thanks, Rich. But yeah, our third best performer was copper. So yeah, again, with that commodity theme continuing there. And again, we've got 7.5% of the fund in copper, which is great, up 3.4%. And we touched on earlier on how well emerging markets are done, led by Korea, becoming the 9th biggest stock market in the world. And that emerging markets were up 2.8% this week. So a good all-round week in positions that we've got big positions in, like I said, we've got 5% in BlackRock World Mining, 7.5% in the VanEck crypto fund, 7.5% in copper, and 10% in emerging markets. So a good week. And that's what drove a week-on-week increase of 1.4%, leaving us now, since inception, up nearly 19%, 18.7%. And year-to-date, up just over 6.1%.
6% this year, and we're only 2 months in.
Ooh,
itchy fingers going.
But look, it's not all plain sailing. India, which is a 5% position, was down 1.4%. I guess not the end of the world. And the Russell 2000, which, as you know, is one of my favourites for the year as a whole, was down 0.6%. Again, we've got 5% in that. And the German DAX, although Europe did pretty well overall, the German DAX was down 0.4%. So yeah, it's a good week overall, because when your bigger positions make those sort of gains, obviously it feeds through, and that's why you have a portfolio. So you can have some things go wrong and other things go well. But if you're doing your job well as a portfolio manager, then you hopefully will get more things that are going up than the things that are going down.
But it's funny, isn't it? Sometimes it just feels right. You know when your overall portfolio is working, and you know when it isn't working. CJ, at the moment, it feels a little bit like, well, make hay while the sun shines.
Well, I think that's a really, really good point there. You feel sometimes that you're in the rhythm of the market. And so this week, when I've looked at it, I mean, clearly we've had other things on our mind as well. We talked about right at the start. You haven't had to think about it that hard, and we've made 1.4%. And so, you feel that it's working your way, but that's when complacency can hit. And every time things go wrong is normally when people are complacent and they think they've got everything, tied down and it's all going as expected.
A little bit like the Welsh team after 7-8 minutes.
Well, you can stop talking about Wales, please. Thank you very much. Now, it's tricky because you can overthink things as well. And so if you sort of say, gosh, we're doing really well, but now I've got danger of being complacent, I need to look at all my positions, I better sell something, then you'll miss out on some of these things. And, if we go back to some of the previous podcasts and we talk about, remember what a connoisseur is someone who's quite happy to just say, well, it's working, I'm going to stick with it because that's how I make a lot of money. But we need to be mindful. We need to be clear that we should be on the watch out for anything that might go wrong. I am convinced, absolutely convinced, we are in a big reversal trade out of the US into other markets. And as the US becomes less of the global index, that will give people more trouble. If you remember when we talked about this a number of episodes ago, if you have a global ETF in your portfolio, 70% of that's in the US. So you've got one holding there, but 70% of that is US equities and US dollar.
It's not that global.
Correct. And what's happened is that institutions who are looking at their performance over the last few years have struggled to perform well without having a lot in the US because the US has done so well. So they put a lot of their money in these things. So as the US starts to underperform, you will find people having to sell what they've got overweight to buy what is underweight. And I think you can see that quite clearly in the performance at the moment of the UK equity market and the emerging markets. It is clear the market does not own enough of these things and is struggling to get hold of them, which is why those numbers are so great. I haven't got the number exactly here, but I think the UK is probably up 10% this year now. Mm-hmm. Emerging markets are going to be pretty close to that. Mark, have you got those numbers?
The FTSE 100 is up 9.2%, and the mid-250s up 5.4%. That was as of last night's close year to date.
So these are huge, huge up moves, and that's telling you that people haven't got enough of them. So I'm convinced this is going to carry on. And what I would say to people is, we have mentioned before that when you get your pension valuation, look at how it breaks down. Where are your investments? But look at what your position is in these international ETFs, in these global ETFs, because you've got a lot in the US there and very little in all these other markets.
I think it's worth going through that is the mechanics of fund management and money flows, isn't it? That as a company gets bigger, then obviously there are more buyers of it, that people become more interested in the stock and they buy it. As it gets bigger again, it goes into indices and it goes into ETFs. So there's more buyers and the tracker funds start buying it. So it gets bigger and the whole thing is self-fulfilling until you've got 70% of a global index invested in the US. What you're saying is that could start to reverse, and you've got a very different story because you've got a lot of money trying to all get out at the same time.
Yeah, I mean, it's really fear and greed. It's all it ever is. The US has done fantastically. And I wouldn't want people to think I'm negative on the US. I went to San Francisco, working, I emphasize, a couple of weeks ago. I love America, but it's done so well over the last 5 or 6 years. It's been brilliant. It's been the right place to have your money, no doubt about it. But people have been underweighting it and gradually over time have increased their weighting. So now they've got to a stage where they're all sitting there going, oh, good, it's fantastic. The US is going to carry on performing and I'm going to be great. And so what happens then? The complacency comes in and actually the theme moves, and the theme is moving now, in my opinion. So what's going to happen is all those people who've got all this big weighting in the States are going to say, God, I need some emerging market. God, I need some UK. God, I need some Europe, whatever it is. So they'll have to sell one to buy the other. So you get this self-fulfilling prophecy starts again.
Yeah.
Of selling one to buy the other. So all I say is look at your exposure. We've got still plenty in the US, but we have reduced it quite considerably and we've put it in the right places. And so that's why we come back to the rhythm of the market. We've got the rhythm of the market at the moment. That's what people are trying to do. We just got to make sure we stay in that rhythm. We don't lose the beat.
Mark, what's the risk to that? What's in favor of the US?
Look, one of the things I was just about to say was that I think people have to also understand that an economy is not the same as a stock market. So I have no doubt the US economy is going to be far and away the best, developed market economy in the world this year. It's probably going to grow at 4 or 5%. The UK is going to do 1%. Europe might do 1% as well, right? But our stock markets are doing better than them. And you just go, but hang on, if the US is growing at 4 or 5%, surely their stock market would do fantastically. But it doesn't work like that because the value of equities don't always work like that. As you say, there's been a huge money flow into these biggest companies, the Magnificent Seven, etc. And that money is now flowing into other areas because they became very highly valued. They anticipated the growth that was coming through. So where we're positioned in the US for that economic growth is in the Russell 2000. I've talked about the small and mid-sized companies because they're the ones that benefit from an improving economy rather than the biggest companies. And, in the UK, if the UK economy starts to get going, we'll want to put some more money in the mid 250 in the UK small and mid-sized companies. We've got 5% at the moment. It's about a marker, and it's up 5%. It's a pretty good result. The Russell 2000 is up over 7% because people are beginning to switch, and the S&P is flat, Nasdaq's down a couple of percent, and money has been flowing out those areas in hunting for things that will do well if the economy does well in the US. But I this is where I disagree with Chris. I think you can't write off the Americans. They're very smart people. They have very innovative companies, and they have a habit of coming back strongly. The Americans dominate the world's asset markets. And when they get worried about things, they tend to take money home to things that they know. Now, at the moment, they're becoming more relaxed about the rest of the world. We're through the big tariff sort of issues that we've had for the last year or so. And so they've been happily taking money out of the US and putting it elsewhere. And, as long as there's not a big blow up somewhere along the line, geopolitics or something, then that trend can continue for a while yet. Those of you who know me know that I've been a big advocate of the Americans for the last 4 or 5 years. And it's only this year that I've started to say, actually, do you know what? I think it's time to put some money elsewhere because there's better value out there. And so far, touch wood, we're working as a team and it's working well. So I'm happy to go with our positioning.
And if I just I'll take issue with your one thing there. I have plenty of faith in the Americans. I think it's a great economy, and I think they are exceptional. But what it really comes down to, and this is where I think a lot of people struggle with the stock market, is it's down to expectations and what's priced in already. Okay? So, I don't know, someone comes out with bad numbers and the stock goes up. Why does that happen, they say? Well, it's because everyone expected the numbers to be bad, and therefore there wasn't any news in the fact it was bad. When I'm at home and I'm talking to various members of the family and they go, oh, this announcement came out on inflation or this number came out there, I can't understand why the stock market did what it did. It's because it's about expectations and what people were thinking. So my only point is everyone's in the US with high expectations. Everyone's out of Europe and emerging with low expectations. So net, if there's a slight change in the views that emerging market UK will benefit from AI because it's now not about who the chip manufacturer is. It's how do you get it into your efficiency of your product and your workplace. And so people start to say, well, there's a lot of benefit there to some of these other places. That's what I think you see swing round. So it's not an anti-America. I like America. I think it's all priced in America. It's not priced in the rest of the world.
I mean, there's an old saying, there's a lot of fat people trying to get through a small door.
Yes.
Right? And it works both ways.
Why is he looking at me? Why is he looking at me when he says that?
I look at myself here,
Just explain what you mean by that, because just for everybody's benefit.
Yeah. I mean, look, when everyone wants to buy something, obviously, there are, everyone's clamoring to buy it. And if there's a very limited amount, then the price will go up a lot. That's how you adjust for it. So everyone's been buying America, as Chris said. A lot of UK institutions, pension funds, having had 20% in the UK, are down to 3% now, which is basically the world index weighting of the UK is 3%. To be fair, we're still the sixth biggest stock market in the world. But at one time, we were the second or third biggest stock market in the world. And, so even Hong Kong and India and Japan are bigger than us, and China, obviously. And the US is biggest at 60%. So you just take a little bit of that 60% out and try and put it into the 3% that the UK is. And, if enough people do it, there's a shortage of supply of equity and the price goes up.
So there's a lot of people trying to do something.
Yeah.
And it's very difficult for them to all be able to at the same time, which is your analogy of a lot of fat people trying to get through a narrow gate.
Indeed.
And the only mechanism to fix that is make the gate bigger or prices go up in this instance.
Yeah. And if the UK stock market became overvalued, then what would happen, first and foremost, is the companies would start to tell you that because they would start to issue more shares to get cash in to put it on their balance sheet to keep for a rainy day. So when you see companies starting to issue lots of new equity or trying to raise money through the bond markets, etc., if they're not using anything specifically for that, then you know that they're a bit worried about their own valuation being too high. Now, we're not seeing any of that in the UK.
No,
so
it's the opposite.
Rolls-Royce. People are taking things over.
Yeah, exactly.
Rolls-Royce announced the buyback.
Yeah. But one of the things that we've seen in America is even though some of those biggest companies have had to raise money through issuing new debt to fund things like data centers, whereas before they were just using their own cash flow to do that. And that was quite a marked change. And I think, I could go back and have a look at this, but my instinct tells me that when we started to see those big companies like Microsoft, like Meta, issue debt to fund data center expansion, that's when you started to see them underperform quite markedly. Before that, and when everyone was comfortable with them using their own cash flow to do this growth, but the minute you had to rely on other people to get the cash in to do that, people started asking questions. And I think instinctively, that's when the Magnificent Seven probably topped out back in October. The Magnificent Seven topped out, and it's been going sideways to down a bit since then.
Not yet made your first investment with IG? Right now, IG's offering up to £200 cashback on your first investment. Make your first investment of £100 or more and you'll get 5% cashback on your investment up to £4,000. That's a straight £200 back in your pocket just for getting started. This offer is open to new customers and any existing IG customers who haven't yet placed a trade on a share dealing account. So if you've been sitting on the sidelines waiting for the right moment, this is it. Just hold your investment until the 30th of June and the cashback is yours. Use the code CASHBACKPODCAST at sign up. That's CASHBACKPODCAST. But don't hang around. The offer closes on the 13th of March. Your capital is at risk. New customers only. Offer valid until the 13th of March 2026 on ISA, GIA and SIP accounts. Terms and conditions apply. The max payout is £200. So talking about the US and this question over exceptionalism, did you see the State of Union address? Do you think they're maybe just a bit sidetracked with so many other things going on at the moment?
Well, I don't know how he managed it, but Donald Trump spoke for 1 hour and 47 minutes. And actually, there was probably only 3 things that were important for stock markets in there. The main one of which is that he's going to give any child born between the 1st of January 2025 through to the end of 2028, so for the next 3 years, and any new child is going to get $1,000. Which is quite a socialist and a nice thing for him to do. That's good. But the Americans can afford to do it. I mean, I think if Rachel Reeves brings that out of the spring statement, which is next week, we'll find out on Tuesday. But I doubt they haven't got the money to do it, sadly.
They haven't. I guess if you've got the money to do it yourself, there's the option of opening a JISA. And that is what an incredible start you can give to your kids' life.
JISA, for those people who aren't used to your anachronisms,
is a junior ISA.
Thank you, sir.
And I did some math on it, and Trump giving $1,000. Well, what if your baby's grandparents or you had the £1,000 yourself to put in when the child's born, and then you put £100 a month away into this junior ISA throughout the years until they're 18. Now, we talk about on the portfolio, we're looking for a 10% return, right? So let's say they manage the 10% return. How much do you think that child is transferred into an adult ISA at the age of 18? So £1,000 in when they're born, and then £100 a month.
A lot. And I'm not going to give you a number because I don't want to look stupid. And I'm sure
and he's the mathematician.
I'm sure. I mean, I can do it on my phone here, but why don't you tell us? Because you've done the homework and I wouldn't want to steal your thunder.
Well, there's so much controversy about student loans at the moment, isn't it? I know we had quite a heated debate about it at the weekend. The average student walks away with £53,000 of debt at the moment.
Aged
21.
21.
So what if you can actually prepare your child for university with this £1,000 in at the start and £100 a month? They will have £60,000 when they're 18 years old, and therefore they don't have to leave university with any debt at all.
It's a great way to save. And, we understand in our very first episode, we talked about the power of compounding and the returns that drives. And you don't have to take big risks with it to do that. It's just literally just add it in week in, month in, month out. And it's a very sensible thing to do as long as you can afford to do it. And obviously, some parents can't afford to do it, and that's fair enough. But
the message from week 1 of this podcast has been to start investing early and compounding, early and compounding, early and compounding. And I want everybody who's listening to this to remember those 2 expressions. Get money in the markets as early as you can, and the power of compounding will give you great returns as long as you can take that longer term view and you have that spare money. That's what you should be doing. So I mean, unfortunately, my children are now of the age where they don't qualify for a junior ISA anymore. But when they were that age, I did every year exactly that to make sure that they were sitting and looking pretty when they got to age 21.
And as we always say, that those numbers, 10% return, nothing assumes that previous returns will go on to be the future. But our portfolio, that's exactly what we're aiming for.
That's what we're aiming for. That's what we're trying to do. There will be times when it's much more difficult. As I said, at the moment, we're in the right rhythm. But stock markets are very good. I mean, in fairness, if you'd bought anything, you'd probably made some good money. So, at least if we've encouraged people to buy things, then that's great. Things will get tougher. And then you'll see what this is really about. But at the moment, roll on the markets doing what they're doing.
£1,000 a year is not the maximum you can put, and you can put away £9,000 for your children. IG have got a junior ISA that's just started. £9,000 maximum. That means your kids could walk away with as much as £560,000 at 18.
Oh, if only my parents knew what a JISA was.
Is there anything else we want to add to the portfolio there, or any changes to make? Are we happy the way it is?
I've not got any changes in mind. I think it's working well, as I said. We know what we're expecting, and what's happening tends to be following that at the moment. So that's always a great place to be, and a nice, comfortable place to be. I am naturally, like most investors, a cautious person. So, and this is probably a kiss of death, but when money's coming to you as easy as it is at the moment on, from the investment portfolio that we've set up, you do have to worry or think about how long that can continue. Not seeing the warning signs. Remember, we said bonds going up in yield would be a warning sign. No sign of that whatsoever. So therefore, it's fingers crossed. Stay with it for me.
Yeah, I'm happy to stay with it. Like I say, I think we're positioned nicely. My only evolution of the portfolio that I've got in the back of my mind is to put more into those mid and small size companies if economies can start to pick up and improve to capture that economic growth.
Okay, good. Well, sounds like we're all happy there. I think we got time for a question. What do you think, Spice?
Oh yeah, let's go for it.
We got a good one from Kieran, actually, telling us that he has a portfolio that's currently doing well. However, 10% of it is in one stock that has performed badly. It's down 50%. His brain is saying to sell it, but his heart is saying ride it out. And his question is it normal to have head and heart decisions with your portfolio? And do you ever get used to those losses?
I think, psychologically, and we've talked a lot about the psychology of investing, you have to be able to make your decision for yourself, for your well-being, if you like. I'm naturally a person who says, I've got it wrong, I want out, and so I can sleep better at night and then come in with a fresh sort of set of eyes and a clear head the next day and think about it again. I may go and buy the position back, but if you've got it weighing on you all the time, it can be very wearing and, it's not a great place to be in. It can obviously cloud your judgment in other areas as well. And remember, when a stock is down 50%, which is a huge amount, it's got to double to get back to where you bought it. It's got to go up 100% to get back to where you bought it. And, very few stocks go up 100%. I hate to tell you, very few.
My answer, always in it, forgetting any tax implications or anything like that, is to sell the position and then buy it back again. And the question is, would you want to buy it back again today if you didn't have the position? So you get rid of the psychological thing of seeing a big red, loss on your screen, and you force yourself into the decision and pressing the button. Would I actually buy it again today or not?
Yeah, I mean, the question is it normal to have head and heart decisions with your portfolio? The answer is yes. All the time, you will have some things that are working and some things that aren't working. If we look at our portfolio at the moment, we've just talked about how well it's done, but there are some things. I mean, I'm going to pick on one and say India. We've sat with India for a year. It's done nothing. It's actually gone down.
Yeah, it's down 3.5%.
So, do you want to stick with that? Would it be better not to have it? Blah, blah. That is completely normal. What you need to work out, though, is what works for you. And different people react in different ways. In podcast 15, we chatted to Lee Freeman Shaw.
Great episode.
Yeah.
And that was one of our best episodes where we talked about his findings of the types of investors there are and how they react to things that go well and go badly. There were 2 for going well, but for this conversation, there were 3 for going badly. And the first one of those was the rabbit, remember? And the rabbit is the guy who just sits there, can't see what to do, doesn't do anything. And the market keeps going down and keeps going down, and he just sits there like a rabbit in the headlights. And nobody wants to be that rabbit. And everyone is that rabbit at some stage of their career. It's how they react to being the rabbit that's important. So the other 2 that he talks about were the assassin. And the assassin is the person who just says, it's reached a level, however they've decided that level, I'm cutting it out, I'm getting rid of it. And the reason that's important and a good way of doing it is because psychologically, you say, I'm out of this now. Yes, I've lost money, but now I'm starting the rebuilding phase of making my money back that I've lost. So you've got completely different mindset. The third type is the hunter. And the hunter says, I've watched it go down, but I'm doing my homework. I like it still, and I'm going to add. Because as Mark says, If you add when it's halved, you've got a chance. You're lowering your in price. So if it goes back to where it started, you've actually made some money. And that's a great place to be. But it really is what suits you best. So Mark is the cutting out brigade. So he's the assassin. Where are you, Rich? What are you on this?
I'd say, looking at my positions at the moment, I'm more of a hunter. I know that I've got some more oracle than I started with. But over my career, definitely a hunter rather than assassin.
And I'm much more of a rabbit than any of those things, because I like to think I'm always right. And the fact is...
Don't we know it?
The fact is you learn over time that the market's always right and you're often wrong. So what I tend to do is I'll sell half the position.
Yeah, fair.
I'll keep some to show, to keep it on my radar, but I will sell some so it's not making a hole in my portfolio. It's not dominating my returns. My returns are then dominated by the things that are working, not by the things that aren't working. So you could have a variety of any of these things. The answer, though, is do something. Whether you cut it all, you cut a little bit, or you buy a bit more because you've done your research. Don't just sit there and be the rabbit.
Is that an answer directly to Kieran? Stop being a rabbit.
Yeah, I think Kieran's obviously a very successful investor from the rest of what he's saying. But in this one, I think he's probably letting the loss-making position run because he's doing well on the other stuff. You can't do that. You've got to look at each position and say, in isolation, what do I think about this position?
And what's really interesting, he gives us some more detail in the email, and it's on a 9% dividend yield.
Oh, yes.
And isn't it funny that that's exactly what we've been talking about?
Back to the conversation at the start.
Yeah. Because as the stocks drop 50%, the next thing is usually the dividend gets cut. So the dividend, now the stock's only on a 4.5% yield, but the share price has predicted it before it happens.
Interestingly, I used to have quite a lot of interaction with corporate brokers, therefore stockbrokers who are advising companies. And when you've seen a fall like that and your dividend yield is 9%, most corporate financiers or corporate brokers would turn around to the company and say, the stock market is telling you should cut your dividend, so cut it. And that's when the companies like, Diageo have just done, cut their dividend.
And Vodafone previously.
And Vodafone. So because that 9% is unsustainable unless your business is improving dramatically. And one of the reasons your share price will be low is because your business probably isn't doing very well,
yeah.
Right? So the lesson, as we talked about earlier on, is a high dividend yield is indicative of problems within a business. And quite like say, if I was sitting with a corporate broker's hat on, I would say, cut your dividend. Save the cash and put it back into start growing or sorting the problems out. Because, if you sort the problem out in a business, it costs you money. Quite often you have to restructure, you have to lay people off, pay them redundancy money or whatever you're going to do to sort the problem out. But that cash would be better used than giving it back to shareholders who are saying, I've got 9% out of this year.
And that, you see, not wishing to flog a dead horse even more than we've done it already, is the same psychological problem. If you're sitting there on the board of that company, you are saying, shall I cut my dividend? Shall I not cut my dividend? Shall I cut my dividend? Shall I not? It's the same as saying, I'm losing money. Shall I do this? Shall I do that? It's exactly the same thing. And what I'm hoping we're getting across to people is take action. So if you're worried about you've got to cut your dividend and you think you maybe or maybe not, just cut it and move on. Get everybody moved on in a fresher place, more optimism coming through. Drive yourself forward. But this is all about psychology. Go back to that podcast. It was a brilliant podcast. Number 15.
Good stuff. Right. If anybody has any questions, where should they write in, gentlemen?
The Art of Investing at IG.com.
Give us a like and a subscribe if you've enjoyed what you've seen today. And join us next week when we will be bringing a wooden spoon in for our Welsh friend.
Dear me. Is he ever going to stop?
See you next week.